All right, and welcome to our session, my Solo 401k Financials weekly YouTube webinar series. We have a great topic today, which is the 2024 Solo 401k setup and contribution deadline, specifically geared towards businesses that are taxed as sole proprietorships, single member LLC taxed as a sole proprietorship, 1099 independent contractor. So first off, with some housekeeping, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. If you're watching this on YouTube, thank you so much for joining us. Please like, please subscribe, please chat over questions if you're on YouTube, as we'll go through questions at the end. We also would encourage you to join our community, as we have daily live Zoom calls on our community. mysolo401k.net/my community. It's always free to join. All are welcome. Before we get into the topic, we want to go over some foundational concepts, starting out with Solo 401k eligibility. So a Solo 401k is for an owner-only business. So thinking like an independent contractor, maybe a solo practicing attorney, and the individual cannot have any non-owner, non-spouse full-time W-2 employees working for any business owned by that person or any spouse, if any. So it's really for self-employed owner-only businesses with no full-time W-2 employees. In terms of some of the top eligibility considerations, do I need to have a separate entity like an LLC or an S Corp? The answer is no. We have many clients, for example, who operate as sole props, right, without a formal legal entity. The key is that you're reporting earned self-employment income on your taxes. So for a business that is taxed as a sole prop or a single member LLC or an independent contractor, that means that that individual would be filing a Schedule C on their 1040, reporting that earned self-employment income on Schedule C of their 1040 to justify the fact that they are self-employed. Now, there's no minimum amount of earned self-employment income that needs to be reported in order to be eligible to set up a plan. But if the goal is to be able to make solo 401k contributions, you can't save more than you earn. So if you don't have a relatively high amount of earned self-employment income, then you're not going to be able to contribute a relatively high amount to the solo 401k. Your spouse or business partner may also participate in the plan, as long as the spouse or business partner is reporting their own earned self-employment income, such as their own Schedule C, for example, for a business that is taxed as a sole prop or a single member LLC, etc. You can set up a solo 401k even if you have a W-2 job, a day job, even if you participate in your W-2 employer-sponsored plan, as long as, again, you have that separate earned self-employment income with no employees working for any business that you own or a business that might be owned by a spouse, if you have a spouse. Let's also continue to lay the foundation in terms of some of the top use cases. So to illustrate this, we'll go through different customer profiles, starting out with the frugal investor. So our plan will make the self-employed business that sets it up eligible to claim $1,500 in solo 401k tax credits. That's $500 per year for 3 consecutive years, which will more than cover the cost to set up and maintain the plan for the first 7 years. Another great use case would be the Roth maximizer. So our plan would allow the self-employed individual to contribute up to $69,000 or even $76,500 if they're 50 or older for 2024 as a Roth or Mega Backdoor Roth contribution. The plan would also allow for in-plan Roth rollovers. So for example, if you have money that's in an existing pre-tax retirement account that's eligible to be rolled over, like a former employer plan or a pre-tax IRA, those funds could be rolled into the solo 401k and then converted to the Roth solo 401k account. The large account holder, once the value of the plan exceeds $250,000, there's going to be an informational filing requirement, which is a Form 5500-EZ. We handle that Form 5500-EZ filing requirement as an optional free service, meaning no additional charge for our customers. And we do it under the electronic filing system, the EFAS system, just to make it easy for the customer. The alternative investor. So our plan would allow for, of course, not only traditional brokerage type investments like stocks, bonds, mutual funds, and we help our customers open up a brokerage account at the brokerage of choice, But our plan also allows for true alternative investing like real estate, private placement, private stock, crypto, precious metals, notes. The rainy day investor. So our plan would allow for 401k participant loans. This is where the individual could withdraw money from their solo 401k and use it for any purpose whatsoever, including a personal purpose. It's not going to be considered a taxable event or subject to penalties as long as it's properly documented as a loan. And we handle the loan documentation requirements as part of our service for no additional charge, and also within the terms of the 401k loan rules. So those loan rules require that the borrower can borrow up to 50% of the balance, not to exceed $50,000. The loan needs to be paid back in monthly or quarterly payments up to the individual, equal payments of principal and interest. The interest is prime plus 1% or a CD rate plus 2%, with those payments spread over a 5-year term. All right, so now let's dig into the solo 401k setup deadline for 2024, specifically focused on businesses that are taxed as a sole proprietorship, like a single member LLC or a 1099 NEC independent contractor with the income reported on Schedule C of the 1040. So there are different deadlines depending on when the individual sets up the plan. And depending on when the individual sets up the plan, that'll dictate what type of contributions they can make and when they have to make those contributions by. So, for example, if the individual sets up the plan by December 31st, then that'll give them the maximum flexibility, the maximum amount of time to be able to make contributions. If the individual sets up the plan after the December 31st of 2024, they can still make certain contributions, but their options will be more limited. So to preserve the maximum amount of contribution types and the maximum amount of time to make those contributions, the individual would need to sign up with us by the end of the year, because signing up with us is all that's needed to meet the deadline. They don't need to make the contributions. They don't need to open the accounts, etc. So for a business, again, that's taxed as a sole prop, could be a single member LLC, a disregarded entity, or a 1099 NEC independent contractor, where ultimately that earned self-employment income is reported on Schedule C of the 1040. As long as they sign up with us by the end of the year, they'll preserve the ability to make all types of contributions, whether employee, employer, or voluntary after tax, anytime up until the 2024 business tax return deadline, including any timely filed extensions. So April 15th of next year or October 15th if they file a timely extension. Now, if they were to sign up and set up the plan after the end of the year, but in time to be able to make the contributions by April 15th, so if they do it, for example, in January, February, March, even the beginning of April, they can still make all types of contributions, but they'd have to make those contributions by April 15th if they want to be able to make employee, for example. So you can still make all types, but the contribution deadline will be April 15th. Now, if that individual sets up the plan after the tax return deadline, the normal tax return deadline, in other words, if they set it up sometime, anytime up until October 15th, but after April 15th, right? They could still make employer or voluntary after-tax contributions. They'll lose the ability to make employee contributions at that point, but they could still make employer or voluntary after-tax contributions anytime up until the extended tax return deadline. So if they file an extension for their 1040, set up the plan, say in the summer or really anytime in the early fall, then they'll be able to make employer and after-tax contributions until October 15th of next year. So if you miss the end of the year deadline, you can still have additional time, but the deadline won't be as late necessarily because you won't necessarily have until October 15th, or you won't be able to make all types of contributions. Hopefully that makes sense. Now, how do you meet that December 31st deadline? Well, we make it very easy with 3 steps, which all can be completed within the same business day. So number 1, you submit our online application, which is just a 1-minute application, 10 simple questions to gather the information that's needed so that we can go to step 2, draft the solo 401k plan documents, which we do that within the same business day. And then within that same business day, we send out an email with a link to our secure portal so you can download the documents that were drafted specifically for your business. You can sign, and now you've met the deadline. You don't even need to return them back to us by the end of the year. You don't need to open the accounts. You don't need to make the contributions. So just signing up, in other words, by the end of the year, we'll meet that deadline. And as we saw in the prior page, preserve the ability to make all types of contributions anytime up until your business tax return deadline. In other words, your 1040 deadline, including any timely filed extension. So October 15th, if you file a timely extension for the 1040. So signing up preserves the ability to make all types of contributions, whether it's pre-tax, Roth, after tax. You can open the accounts, you can fund the accounts anytime next year by your business tax return deadline, including any timely filed extension. So that's going to give you the ability to contribute up to $69,000 or even $76,500 for 2024 in 2025. Of course, subject to those contribution rules, right? You got to have the income to justify the contribution. So just to dig deeper into the steps, right? Step 1, again, submit the online application, mysolo401k.net. Click on open account, click on solo 401k, 10 simple questions. We collect the information to draft the documents, because the documents is what creates the plan. A solo 401k plan is a legal entity. It's a trust. So like any legal entity, it's the documents that create it. And we provide all the documents that are needed to create it, along with the favorable determination letter from the IRS that confirms that the plan is a qualified plan. Now, an EIN number will need to be obtained for that solo 401k, but that can be obtained next year once you're ready to open the accounts. And we'll obtain that EIN number for the solo 401k as part of the onboarding process. We pre-fill all the paperwork specifically for your business. The transmittal email will specify exactly where you need to sign. You could sign it with an electronic signature, for example, if you have electronic signature software. Again, we send out those documents within the same business day. So you just need to sign the documents to meet the deadline, and that'll preserve the ability to make all the contributions. As long as you do that by the end of the year, all the contribution types, whether employee, employer, voluntary after tax, anytime up until your tax return deadline next year, including any timely filed extension. So in short, you can take your time. Now, once you're ready, which could be now in 2024 or next year in 2025, you go on with the remaining steps so that we can help get those accounts set up. So you return the signed and completed documents back to us. Again, there's a secure upload link in the transmittal email. We then take you to a page on our website. So from that same transmittal email, we'll take you to a page on our website where you tell us, it's a quick 1-minute questionnaire where you tell us where you want to have the accounts. So we are totally neutral as far as where the accounts are at. We've helped clients open up accounts at hundreds of different banks, many different brokerages like Fidelity, Schwab. Once we get those signed and completed paperwork back, we go ahead and get the EIN number for the solo 401k. And once you let us know where you want that the accounts are at, when you're returning the completed and signed documents, we'll also prepare the paperwork that's needed to open the account. So for example, if you say that you want to make Mega Backdoor Roth contributions and you want to have the accounts at Fidelity, we would prepare paperwork to open up 3 accounts at Fidelity: a pre-tax, a Roth, and an after-tax. And then it's going to be a similar process where an email goes out with a link to our secure portal where you can access the pre-filled documents. You just download, you sign, you upload, we review and compile so that the paperwork can be submitted to Fidelity to open the accounts. And then once the accounts are open, it's time to make the contributions. So again, as long as you sign up with us by the end of the year, you'll have plenty of time to make those contributions. Once you've determined exactly how much you've made, how much you can contribute, and how much you want to contribute. So those contributions would go into those accounts that we would have helped you set up as part of that onboarding process. Now let's go talk about some of the top FAQs. Do I need to obtain an employer identification number by the end of the year, by December 31st? No, you don't. Because if you look at the IRS guidance, all that needs to be done by the end of the year is to establish the plan. A 401k plan is a legal entity. So what establishes the plan is the documents, which we draft the same business day. So you don't need to open the accounts. You don't need to get the EIN number. All of that can occur next year, right? So to the next common question, do I need to open the accounts? No, you don't. Again, just that can occur next year, anytime up until the business tax return deadline, including any time they file an extension, just in time for you to make those contributions next year. And as mentioned, we're very hands-on in helping you open up the accounts at the bank or brokerage of choice. Do I have to make both my employee and employer contributions by the end of the year, by December 31st? No, you don't. Again, all you got to do is sign up and set up the plan. And this is clear based on IRS Publication 560. We have a snippet of IRS Publication 560 here on the screen. IRS Publication 560 is the landmark guidance for self-employed retirement plans like solo 401ks. There's a chart on page 3 that makes clear that when to set up the plan is by the end of the year. And then that makes the last date for contributions, right? Whether it's elective deferrals, which is also just a synonym for employee contributions, or employer contributions by the tax return deadline, including any timely filed extension. So for a business that's taxed as a sole proprietorship, right? It could be a single member LLC, a disregarded entity, could be a 1099 NEC independent contractor, where the income is being reported on Schedule C of the 1040, right? That means really your business tax return is your 1040. So that means the deadline is the 1040 deadline, including any timely filed extension. So that's April 15th or October 15th if you file a timely extension. So another common question is, okay, if I adopt the plan here in December of 2024, or by December of 2024, how can I make contributions based on income that I earned in January of 2024? Well, the industry best practice is to draft the plan documents effective as of January 1, 2024. So that means that all the income that you earn and report for 2024 for your self-employed business can be used to justify contributions to the solo 401k. So even if you sign up on the last day of the year, you're still going to be able to use all the earned self-employment income that you report for 2024 to justify contributions to the solo 401k plan. My CPA tax advisor is informing me that the employee contribution must be made by the end of the year. Are you sure that I can make this contribution in 2025? Well, yes, we're definitely sure. As we showed you from IRS Publication 560, it's crystal clear that the deadline for self-employed individuals that set up the plan by the end of the year for all types of contributions is the business tax return deadline, including any timely filed extension. But this point of confusion is understandable coming from a CPA or tax advisor who might be familiar with the rules that apply to full-time employer plans. So for a full-time employer plan, like one that you might have in corporate America, right? The employee contribution deadline is the end of the year. But the rules are different for self-employed individuals, which makes sense from a policy perspective because many self-employed individuals don't know how much they've made until after the end of the year, right? They may have a seasonal business where they're earning a lot of income all the way up until the end of the year, and they really don't know exactly how much they've made until after the end of the year, once they've run all their numbers, et cetera, et cetera. So the rules give those individuals more time. So it makes sense from a policy perspective why a self-employed individual could take more time to figure out how much they can contribute and how much they're going to contribute and to actually make those contributions. So yes, so we made it clear that the deadline is the tax return deadline, including any timely filed extension, as long as you sign up by the end of the year. So this is a great chart as it shows the deadline for all the different business types. We've been trying to focus on sole props. So as long as you sign up at the end of the year, it's going to be that 1040 deadline, including any timely filed extension. Please continue to follow us on our community. We go live every day, mysolo401k.net/my community at 1 p.m. Pacific, 4 p.m. Eastern. We have forums as well where you can post questions 24/7. We have a deep dive library of videos and webinars. So there's a lot of great ways to learn and to share the knowledge. course, it's always free to join. All are welcome. We appreciate all the participation. We're going to start to go through those questions. All right. So I'm assuming this is someone who's thinking about restating a plan from E-Trade, upgrading the plan, in other words, to our plan to be able to take advantage of the service and features of our plan, whether it's the Mega Backdoor Roth or the 5500 EZ or the tax credit. So that's a very common situation where someone starts out with a basic plan at a discount brokerage like E-Trade and then wants to upgrade to our plan. So in that situation, the existing plan is not terminating and a new plan is starting. Instead, it's what they call a restatement. So the existing plan continues, but now it's governed by our IRS approved documents. So in order for us to properly draft the documents for that person's situation, we need to know the original effective date. So most definitely you could send a secure message, for example, to E-Trade, or if you could get a hold of the adoption agreement, it would be listed on there. Oftentimes it's January 1 of the year that the plan was set up. But that information could be provided to us and then we could draft the documents accordingly. Thank you so much for the great question. Is rollover from existing 401k accounts considered a contribution? Since contributions are limited based on business income, if I'm not reporting any income, can I roll over $60,000 from my existing 401k? Fantastic question. It's a common question. So the contribution limits would not include rollover contributions. So as long as someone is eligible to set up a plan, right? They're self-employed with no full-time W-2 employees working for any business owned by that person or a spouse, if any, they're going to be eligible to roll over money from an eligible account. So in other words, from a former employer plan, typically you can't transfer money from a current employer plan until you actually leave your job, or from a non-Roth IRA. You can't transfer money from a Roth IRA to any type of 401k. So you're looking at a former employer plan or a non-Roth IRA. Now, once you're eligible to set up the plan and you have money that's eligible to be rolled over, there's no limit on how much you can roll over, right? That's not going to be considered a contribution. It's not going to count towards the contribution limits. I also note that we help our customers transfer money from existing retirement accounts. And as you might imagine, each of those companies from where people are transferring funds will have their own unique process. So we track that experience to make it easy for our customers. But we've helped customers over the years transfer funds from hundreds and hundreds of different places. And we've tracked all that experience to make it easy for new customers, right, to roll over money from wherever they currently have their accounts at. Great questions. Thank you. Let's see here. I have an E-Trade retirement accounts and already contributed to my 401k and Roth 401k in 2024. And I want to transfer in kind to Fidelity. Would you restate the Fidelity accounts, then fund them to Fidelity or open? So I think you'll have a solo 401k or an individual 401k at E-Trade. So that's the account that would be restated. So if you want to transfer in kind, we definitely have a lot of experience with that. And let's say you want to have the new accounts of Fidelity. That's one of the top places where we're helping customers open up accounts. But if you want to go in kind based on experience, it would really be a two-step process. What we would likely do is help you open up new accounts at E-Trade under the name of the restated plan, new accounts at Fidelity under the name of the restated plan, then move the cash and assets from the existing accounts. We prepare the paperwork to move the cash and assets from the pre-existing solo 401k accounts at E-Trade to the new accounts at E-Trade for the restated plan. Now the name on the new account at E-Trade will match the name on the new account at Fidelity. Then we can help you prepare the paperwork that Fidelity requires to go and retrieve those assets in cash from those accounts at E-Trade. And under that process, they want the account names to match. So by moving it to those new accounts at E-Trade, that'll satisfy that requirement that the accounts names match. And then the cash and assets can go over to Fidelity, assuming that they support that particular investment, right? There might be certain mutual funds that you can't invest in through a Fidelity account. But yeah, we would definitely have a lot of experience with that and help you through that whole process. I have a questions for reporting contributions. Why does the Roth employer contributions are first reported as tax deductible for the year for which the contributions are made? Great question. So it's because that's what the IRS says to do. And so the Secure Act 2.0 enabled employer contributions to be made as Roth contributions. Prior to that, those contributions were always pre-tax contributions. They would reduce the taxable income, right, for the year for which the contributions were made. Now, with the ability to make Roth employer contributions, there was an open question of how to report those, right? So it wasn't until almost a year later that the IRS answered that question and specified that those contributions need to be reported as tax deductible for the year for which the contributions are made on the employer's tax return, which would really be the 1040, right? If our business tax is a sole proprietorship, but then taxable, because it's a Roth contribution, it needs to be made ultimately on an after-tax basis, but taxable to the employee for the year for which the contribution was deposited. So that was the resolution that the IRS came up with in kind of answering that conundrum of how to report those contributions. And so you could think of it from a reporting perspective, it's really no different than as if somebody had made a pre-tax employer contribution and then immediately moved the money to the Roth account. So that pre-tax employer contribution would be tax deductible for the year for which the contribution was made. Could be for the prior year, right? If they're making contributions in the following year, which, as we saw from the prior slides, right, you can make contributions anytime up until the business tax return deadline, including anytime they filed extension, right? As long as you set up the plan by the end of the year. So you could be making contributions in 2025 for 2024. But if it's deposited in 2025, right, it's going to be taxable to the employee in 2025. So you'd effectively be reducing your income for 2024, but then raising it back up for 2025. So again, it's akin to as if somebody made a pre-tax employer contribution, then immediately converted it from the pre-tax account to the Roth account. So you don't have to do that two-step process when you're making a Roth employer contribution. But from a reporting perspective, that's what the IRS guidance, which ultimately came out almost a year later, says to do. Now, for our customers, they've always had the ability to make Mega Backdoor Roth contributions. So in our experience, most of our customers, if their goal is to make Roth contributions, will just skip making employer Roth contributions. And they could just go directly to making voluntary after-tax contributions, which they've always been able to do. And with voluntary after-tax contributions, unlike employer contributions where the limit is a percentage of your self-employment compensation, for example, for a business tax as a sole proprietorship, the employer contribution limit is 20% of your self-employment compensation. But unlike that limit where there's a percentage, the voluntary after-tax contribution limit is 100% of your self-employment compensation. So you can contribute 100% of your self-employment compensation dollar for dollar up to the overall limit, right? Assuming you don't make any other type of contributions to the solo 401k, because the sum of those contributions can exceed the lesser of your self-employment compensation or the overall limit. But as you can see, you don't need as much income to justify contributions because you can contribute 100% dollar for dollar. So because of that, because of the confusion, at least until the IRS answered the question about how employer Roth contributions are made, and because you have more flexibility with after-tax contributions, right? Because if you make a voluntary after-tax contribution, those voluntary after-tax funds could be transferred out of the solo 401k to a Roth IRA. Whereas if you make employer contributions on a Roth basis, you would have to meet a triggering event before you could transfer them out of the solo 401k to a Roth IRA. So because you have more flexibility, because the limits, you don't need as much income to hit the overall limit, and because of the reporting rules, so even though they've clarified how to report employer Roth contributions, voluntary after-tax contributions are not reportable. So that's also more streamlined. Now, the subsequent transfer from the voluntary after-tax account to the Roth IRA or the Roth 401k is reportable on a 1099-R, and we handle that as an optional free service for our customers. But for all those reasons, in our experience with our plan that already allows for the voluntary after-tax contributions, we don't really see based on feedback, right? A large number of customers making employer contributions as Roth contributions. But hopefully that helps. So yes, Roth are made on an after-tax basis, and it ultimately will be after tax because it's going to be taxable to the employee for the year of the deposit. Thank you for the great question. If you have rental condo on your name or trust, can you do a 1031 sale and combine money from sales with solo 401k money you partner with? So you cannot use a 1031 exchange is definitely not going to apply to real estate sales made by your solo 401k. So that's, I think, going to answer your question right off the bat. Let me know if you have any follow-up questions. Thank you for the great participation. And I think we answered this one up above. About the in-kind transfer. Now, as far as making the contributions, you would make those contributions to the new accounts for the restated plan if you're going to be making after-tax contributions, of course, because the E-Trade account is not going to support that. So, but again, as long as you sign up by the end of the year, you're going to have plenty of time to make all those contributions up until the business tax return deadline. Well, actually, as a matter of fact, if you already have a solo 401k, you would have already met the deadline. So you just need to restate in time to be able to make the contributions for 2024 by the business tax return deadline, including any timely filed extensions. So you could even restate, after the end of the year. Hopefully that helps. Thank you for the great participation. I already have a self-directed solo 401k and corresponding EIN. I was set up at another provider many years ago. What is the process to switch to my solo 401k? We would want to discuss that with you. So I would encourage you to please book a call at mysolo401k.net/book. But if you already have accounts open under the name and EIN number of the plan, then oftentimes you can just keep those accounts. You don't have to, right? If you wanted to, as part of the process, open up accounts somewhere else, we would also, of course, help you with that. But if you already have accounts opened up under the name and EIN number of the plan, you could just keep the accounts where they are. Now, the plan would still be restated to our plan, right? Because we can only support our plan. And then that's going to now include the tax credit. Of course, it's going to include all the features like the Mega Backdoor Roth, alternative investments, etc. Hopefully that helps. So if you are a sole proprietorship, you may not have an EIN number for your business. You may be operating your business through your Social Security number, and that's totally fine. There's no requirement to have an EIN number for your business to set up a solo 401k with us. Now, you do need an EIN number for the plan, and we obtain that EIN number for the plan as part of the onboarding process. So the benefit of, yes, there are some of the discount brokerages there's a handful now that allow you to make Roth contributions, but they don't allow for employer Roth contributions. They don't allow for after tax for Mega Backdoor Roth contributions. They generally don't allow for the in-plan Roth conversions. So the advantage of us is that you can make more contributions into that Roth account, right? With the Mega Backdoor Roth, you're going to be able to contribute up to $69,000 or even $76,500 if you're 50 or older, as long as you got the self-employment income to justify the contribution. We handle the 1099-R that would be needed as part of that Mega Backdoor Roth contribution, right? And then on all the other benefits, plus also the ability to convert pre-tax to Roth money. So some of those handful of discount brokerages that might allow you to make Roth employee contributions, they typically don't allow you to make in-plan Roth conversions where you're moving pre-tax money that you already have to a Roth account. And then all the other benefits, right? Like the 5500 EZ, the 1099-R, alternative investments, the tax credit, the ability to take 401k loans, et cetera, et cetera. So there's a lot of other benefits. We go live every day in our community, mysolo401k.net, and we oftentimes discuss ROBs. There hasn't been any changes in the Rob's rules of significance to report on. So the content that's out there is still applicable, most definitely. And we are helping customers every day with Rob's 401k plans. So we'd be happy to discuss that with you. If you go to our calendar, mysolo401k.net/book, you can book a Rob's 401k call. Thank you so much for the participation. Over 77 years, what is the max contribution amount in 2024 for solo 401k? $76,500 if you have the self-employment income to justify it. So it depends on the type of contribution that you're looking to make. We did a series of YouTube webinars specifically on how much income that you're looking at, how much income you need. So what's that magic number, in other words, to justify the contribution? I'm going over to our YouTube channel here. I'm going to grab the session specifically for solo 401ks. All right, perfect. Found it. Take a look at this session. We go through all the details. And here's the page on our website where we have an infograph. Because right, it depends on whether you're trying to do Roth or pre-tax, what your goals are. So we go through different scenarios to help paint the picture. Okay, great. Yeah, that's how that's another way, that's a way to think about it. Yeah. Of course. Please feel free to book a call and we can go through your scenario, run the numbers. We talked about that. Thanks for your patience as we're going through these questions. The reasoning behind a separate EIN for the 401k, I mean, that's the way that the IRS has always expected things to be done for the 401k. As a matter of fact, that's the way that we've always done it. And the IRS has language on their website that tracks language that was previously on our website, that predates and still on our website as far as obtaining the EIN for the 401k and some of the rationale. And so it was great confirmation, right, that we've been doing things the right way. And it makes sense from a practical perspective because a lot of times with our clients, right, they might have a bank account that's earning interest. They might be invested in some type of private placement where income is being reported with respect to the solo 401k. Take a simple bank account example where the bank is issuing a 1099 INT to report the interest income to the IRS. Well, the bank is going to issue that 1099 INT under the EIN number that was used to establish the solo 401k. So if the bank account for the solo 401k was opened up under the social security number of the solo 401k participant or under their business EIN, well, now the bank is going to issue that 1099 INT under that same tax identification number. And now the IRS is going to look for that interest income to be reported on the personal tax return or the business tax return, which of course the individual would not do because the income is being earned on a tax deferred basis inside their solo 401k. So by having that separate EIN number that we obtain as part of the onboarding process, we're letting the IRS know that this EIN number is associated with the 401k. So if they do receive a report about income with respect to that EIN number, the IRS will understand that the income is being earned on a tax deferred basis inside of a 401k and not look for it to be reported on the personal tax return or the business tax return. Yeah, I'm not sure if you can combine, if you can satisfy, I'm understanding that you're trying to do a 1031 exchange yourself personally and use some of the solo 401k money to satisfy that 1031 exchange. So the first query would be whether or not that's even possible, right? If you can have different owners and still satisfy the 1031 exchange, right? Because one owner would be the solo 401k owner initially, and then with the subsequent owner would be the solo 401k owner along with their solo 401k. So then the next part of your question is whether or not you can combine personal money and retirement money. So theoretically, yes, you can, but it would need to be what they call a tenancy in common. And those tenancy in common rules are fraught with compliance pitfalls. For example, the expectation is that the solo 401k owner would be able to demonstrate that they could have made the investment without the need for the 401k funds. So they weren't using the 401k funds just to personally benefit, just to enable them to make an investment that they otherwise couldn't be made. Moreover, the individual is still going to have the same restrictions. They're still going to have to follow the solo 401k real estate investment rules. In other words, they can't use the property for personal use. They can't work on the property. It's got to be a totally passive investment. In addition, the investment's going to have to be a 100% cash deal. They're not going to be able to use financing to make that investment, right? The title of the property is going to have to reflect the tenancy in common ownership, right? One owner is going to be the solo 401k trust. The other owner is going to be the individual personally. So don't have the answer on the 1031 exchange, but have a question about that. It's possible to use your personal money and retirement money subject to those tenancy in common rules, but it's not typically seen for the reasons mentioned. If I had a self-employed 401k with my S Corp and transferred to my solo 401k, is the $500 tax credit eligible because the previous Fidelity is not a qualified plan? About eligibility. So in short, yes, you can restate a basic plan, for example, at Fidelity to our plan, and then that individual would still be able to claim the credit because now they're adding on the automatic contribution feature, for example, in 2024, and therefore be able to start claiming the $500 credit for 3 consecutive years, starting when they file their 2024 taxes next year. All right, wonderful. Thank you for all the great participation. Please continue to participate. As mentioned, we go live every day in our community, mysolo401k.net/my community. We're going to be now resuming as we go into the end of the year, these weekly webinars on YouTube. So please subscribe so you can get access and notifications. You can watch the recordings at your convenience. You can also go back to the community 24/7 and post questions in our forums. You can check out our library of videos and webinars there as well. So thank you so much for the great participation. We'll give it another moment to see if there's any final questions. All right, until next time, everyone, take care.